Markets just demolished gold and silver these past 2 weeks, hitting brutal lows Friday while everyone's pinning it on Fed chair drama. I wasn't going to film this, I'm midday handling life, but after watching the tape, I realized what they're trying to sell you. The loudest voices push convenient stories, but if you're holding metals or considering positions, you deserve the real picture. It's Tuesday, February 10th in New York. Comment what day you're watching from, and let's cut through the noise. Here's what actually happens during volatile stretches. Markets don't just move price, they manipulate attention. Yesterday you're a genius riding the rally. Today you're an idiot watching it crash. The consistent winners refuse emotional gymnastics. Translate wild volatility properly. Liquidity dried up, leverage got squeezed, headlines became weapons, and markets hunted weak positions. Smart people get shaken when position sizing is wrong or timeframes don't match strategy. Metals confuse people because they don't behave like stocks. Stocks have evolving narratives. Earnings, scandals, leadership changes. Gold's narrative is older than us all. Gold is trust. It doesn't need weekly reasons. It needs the fundamental reason to stay valid. Paper promises historically get overextended. Here's your mental trick. When price moves emotionally, ask whether reality changed or positioning changed. Reality shifts slowly. Positioning flips in hours. These weeks showed massive positioning behavior. Chasers trapped, forever holders discovered stop losses, dip buyers went silent, signaling forming opportunities. Your clean framework. Gold is the macro thermometer. Silver is the amplifier. Gold reveals what the world thinks about money. Silver shows how emotionally they react. Keep these roles straight and stop expecting silver to behave calmly or gold to move like meme coins. Everything shook recently. Metals, stocks, crypto, even boring assets. Those periods where headlines make your brain scream to act dramatically. That's the trap. Zoom out. Gold and silver still won the race. Not hourly, but on the scoreboard that matters, outpacing major indices year to date, repeating last year's pattern. Silver acted like it chugged energy drinks before driving stick shift through blizzards. But judging entire strategies on one ugly candle means letting a single frame decide the movie's ending. When people say metals dropped, they mean from whatever recent peak they fixated on. That's emotion disguised as analysis. Better question, compared to what? Compared to unspent dollars, cash sitting idle while real goods prices climbed, alternatives you almost bought? Recent years saw quiet damage in places feeling safe. Cash doesn't scream losing value. It erodes politely, like slow tire leaks you miss until highway bound. Through that lens, pullbacks look like what bull markets do, shake you to test commitment. Consider this. If you didn't hold metals, what would you hold? Most don't choose between gold and stocks. They choose between gold and doing nothing. Between silver and cash, because it feels calm. Calm isn't safe. Safety is purchasing power, optionality, not being forced to sell. When I say cash quietly leaks, I'm demanding honesty. Higher grocery bills are math. Higher insurance is your statement. Higher rent is your lease. Metals keep finding buyers after pullbacks because people store effort. Money is stored effort. When effort gets diluted, they seek containers leaking less. Gold's been that container. Silver can be too, but silver sloshes when carried. Don't blindly buy every dip mentioned online. Sometimes dips are staircase tops. We need structure, signals, plans not powered by adrenaline. What about the dollar? Yes, it matters. Dollar strength stalls metals. Dollar weakness lets them breathe. But the dollar is a mood indicator with hard-swinging short-term moods. It bounces for reasons unrelated to long-term health. Trader crowding, month-end flows, risk-off capital, scary headlines. Bounces aren't diagnoses. Dollar bounced, therefore metals are finished, is like saying, it rained, therefore summer's canceled. The same people pretending perfect dollar forecasts can't predict monthly budgets. Another narrative? Tougher central banks mean vanishing liquidity, mean collapsing metals. Be realistic. The system carries enormous debt, rolls massive refinancing, dislikes sustained high real rates. Even with tough messaging, constraints are real. Markets often price both tough talk and eventual easing simultaneously. That looks contradictory if you're new, normal after multiple cycles. Here's the recent ingredient. Markets latched onto potential central bank leadership changes. Suddenly, everyone pretended one appointment rewrites gravity. The dollar steadied, metals wobbled, commentary went overdrive. Could that spark things? Sure, but matches need gasoline already present. This was crowded positioning. Metals rallied. Traders piled in. The only goes up crowd got loud. Markets then don't need perfect pullback reasons, just reasons sounding good on television. Public stories center on people. Actual moves stem from positioning. A second boring ingredient? The real economy sent mixed signals. Shiny headlines can coexist with underlying softness. Cooling job openings, cautious hiring, consumers prioritizing essentials. Pressure builds quietly. Markets then price easier future policy whether officials like it. People think tougher-sounding bankers automatically mean no cuts, no liquidity. Policy is response functions. If economy slows, unemployment rises, credit tightens, systems lean towards support, especially when politics are loud. Based on recent data, odds for easier conditions later persist. Does this guarantee immediate rallies? No. It means the fundamental tailwind hasn't reversed. Gold, the adult in the room, took a hit, bounced, then reclaimed key trend references technicians watched during bull phases. The 50-day moving average isn't magic, but behavioral. In high-momentum markets, price lives above it. When price dips below, the question is whether buyers defend when it matters. Recently, they did. Gold can retest lower levels. Markets love revisiting pain like cats testing countertops. But damage looks more like pullback within bigger trends than new bear markets. Missed detail. Futures versus spot behavior hints at control dynamics. When futures lead then stabilize, hot tourist money got rinsed while remaining hands are steadier. Watching broad flows reveals loudest bearish bets cooled as pullbacks matured. That's what you want seeing when seeking bases. I watched 3 things during gold pullbacks. Does it defend trend references on closing basis? Do sell-offs look like panic or controlled profit-taking? Does the market quickly reject lower prices? Lately, we've seen that third element. Long lower wicks on bigger candles matter psychologically. Sellers tried, pushed, then buyers seized control and reversed. Candles reveal the present, who showed up. Buyers defending key areas while narratives scream isn't weakness, it's resilience. Another clue, second day after panic. Day 1 is emotional. Day 2 reveals if emotion's contagious. If day 2 fails breaking lower, markets often build floors. Zooming to weekly views, gold still operates within larger uptrend channels despite messy dailies. Stop obsessing minute by minute when your plan measures in months. Your brain wasn't designed handling constant pricing. That's new human-invented problems making people stupid. If gold chops sideways into spring, that's digestion, not wasted time. Digestion phases let you add without panic premiums. Silver doesn't offer same kindness. It overshoots both directions, requiring different sizing. Gold can frustrate everyone by chopping, drifting, building ranges while social media argues. If you need daily fireworks, ranges feel dead. But ranges reload trends. I'm saying weeks, possibly into spring, because markets anchor around policy milestones. Meetings don't control markets, but give excuses to pause. If geopolitics flares, supply threatens, energy spikes, timing compresses fast. Have plans for sideways, surprise rallies, deeper shakeouts. Silver isn't gold's little brother. It's gold's chaotic cousin, arriving late, talking loud, leaving with everyone's attention. Silver has dual personalities, monetary and industrial, explaining different behavior. When scared, gold gets hugged first. Silver lags. But when momentum returns with firm industry demand, silver moves like compensating for lost time. The complex ingredient, major delivery month approaching in U.S. futures. People whisper, what if they can't deliver? The internet cartoonifies real mechanics. Futures are mostly paper promises. Most never end with trucks hauling metal. They close, roll, cash settle. Hearing contract volume is hundreds of millions, while deliverable inventory sits around 100 million, might trigger panic. Right question: how many actually stand? Only slices ever take metal, changing based on price, stress, incentives. Imagine scenarios where slices are larger, mid-teens percentages maybe. Vault draws could create nervousness, especially if metal's already spoken for. Here's the twist. Even if exchanges deliver, it creates stress because delivery isn't just metal existing somewhere. It's metal available in right forms, places, paperwork, timeframes. It's logistics. You can have global plenty yet pipeline pinches. Silver is pinch sensitive because industrial sides don't care about charts. Factories need inputs. Does March automatically moonshot? No. Sometimes delivery fears get priced early then fizzle. Markets find supply. Big players negotiate behind scenes. Can't deliver storylines can be marketing creating urgency, making you emotional. Emotion is expensive. We treat it as risk factor, not guaranteed catalyst. But we don't ignore it because if stress becomes real, silver responds quickly. Add liquidity windows. When certain regions step away for holidays, price gets weird. Thin liquidity sharpens moves. Stops get hunted. Planning entries means watching calendars, leaving room for nonsense. Silver's demand mix is changing. More electricity consumption, data infrastructure, electrification. Industry innovates but transitions take time. Supply isn't on-off switches. Much silver supply ties to other mining as byproduct, meaning even if prices scream, production doesn't instantly surge. When will silver make new highs? Depends whether next surge is investor-driven, industry-driven, or both. Investor surges happen fast. Industrial stress builds, then snaps. When they overlap, silver gets dramatic. The part nobody likes: drawdowns. Could silver test low 27s? Sure. Mid 25s and nasty liquidity? Possible. I'm saying it's within silver's capability for punishing overconfidence. This is why I prefer staged buying. Dollar cost averaging is boring but effective, letting you participate without pretending you nail bottoms. Scale in on weakness. Keep dry powder. Size so you sleep. If your position makes you check prices every 5 minutes, it's oversized. That's panic wearing a helmet. If you're successful, share your story in comments so others stay motivated. When someone says deliverable silver, there are layers. Silver exists but isn't in right vault categories. Silver's in right vaults but isn't offered. Silver could move but incentives aren't there. What matters? Marginal ounces available without chain reactions. If enough want physical, exchanges have options. Encourage cash settlement, nudge rolls, shift incentives. They solve problems without public failures. Watch stress signals. Stress signals. Nearby contracts trading at premiums to later contracts, subtle tightness. Jumpy lease rates. Stubborn premiums in physical markets. Inventory declines in categories mattering for delivery. Practical takeaway. Silver stress shows in plumbing before headline charts. Only watching price means you're late. Silver's being pulled multiple directions: industry demand, investment demand, emerging market buyers, supply tied to other mining cycles. This makes silver prone to sudden channel shortages, even when the world isn't out of silver. Gold's been in powerful trends because trust is questioned. Fiscal discipline, stable purchasing power, endless debt expansion. When questions get louder, gold benefits. Silver benefits, but demands patience because it's also a commodity with industrial cycles. Central banks have been consistent buyers, and dips met real demand. That's not retail moods, it's structural bids. When structural bids exist, pullbacks become opportunities. What happens next? For gold, base case is consolidation, choppy range-bound action making people bored. Then, if macro stays supportive, gold challenges highs. For silver, prepare 2 paths. Path 1. Stabilizes, turns up around March, grinds higher before clearing peaks. Path 2. One more ugly flush during thin liquidity, tags lower support, reverses hard when nobody wants it. Both lead to same destination but feel emotionally different. Here are my questions. Are you scaling into this pullback or waiting for deeper shakes? Does gold make the next decisive move, Or does silver steal the show? Drop answers below with what day you're watching from. Gold can challenge highs sooner than expected once ranges finish. Silver takes longer healing, rebuilding trust after violent swings. Reasonable expectation. Silver needs several months properly retesting, then pushing through prior highs. If that feels slow, good. Slow builds strong foundations. Something never discussed. The cost curve. Commodities rise because supply gets expensive. Mining became harder, permitting slower, costs matter, ore grades aren't improving. Capital markets are cautious funding projects. When people ask why can't miners produce more, answer is, they can, but not instantly, not cheaply. That's why metal bull markets last longer. Supply response is delayed. Violent pullbacks transfer metal from weak to strong hands. Strong hands don't sell because someone yelled on television. Simple executable plan. 1. Decide time horizons. 2. Decide position sizes. If you can't sleep, you sized wrong. 3. Decide entry methods. All in is flexing, scaling is strategy. 4. Decide exit rules. Even long-term holders need plans for what enough looks like. Answer before markets give reasons to act, because not deciding ahead means deciding in worst moments. When will we see new highs? Gold could challenge highs after spring digestion, especially if markets keep pricing easier conditions or geopolitics tightens stress. Silver may need longer runways. Several months is reasonable modeling. People want certainty. Markets offer probabilities. Build resilient decisions, not brittle predictions. Metals connect to broader risk sentiment. If stocks wobble, money seeks stability. If digital assets swing, money seeks things not depending on servers. Metals sit in the middle. They're not perfect, but they're real. In increasingly digital, leveraged worlds, real has value rediscovered during stress. The popular story says this pullback was about one headline, one personality. That's lazy. This was crowded trades meeting liquidity events with convenient narratives attached afterward. That doesn't make metals dead, it makes them alive. The more alive something is, the more it tries bucking you before rewarding you. One last test, separating tourists from pros. If you can watch pullbacks without needing to act, you're ahead of most. If you can add calmly when uncomfortable, you're ahead of more. If you can hold through boredom, you're rare. That's where big wins come from. If this gave you clarity, share it with someone staring at red charts right now. Drop your thoughts in the comments. Are you buying this dip or waiting? What day are you watching from? And if you found value here, hit that subscribe button because we're cutting through the noise together. This is educational content, not financial advice. I don't know your goals or risk tolerance, and I could be wrong. Do your homework, consider your situation, and only take risks you can live with. See you in the next one.